In this video, I'll show you two main ways to invest in gold in Australia this year. Let's get straight into it. The first way to invest in gold is to buy physical gold. This is the traditional method that the older generation are probably used to. In Australia, you can buy either gold bars or gold coins as a form of physical gold. Gold bars are available in various sizes, from as small as 1/10 ounce to as large as 1 kilogram or more. Cast bars are typically more affordable, while minted bars offer a polished finish and may carry a premium. Gold coins are popular among investors for their liquidity and collectability. Some popular examples include the Perth Mint's Kangaroo series and the Royal Australian Mint's coins. Coins are often easier to trade. Where to buy physical gold in Australia? Here are some reputable places where you can buy physical gold in Australia. Now please note, I am not sponsored by any of these companies. I was not paid to mention any of them. They simply came up as the most recommended and popular options during my research. The first place is the Perth Mint, which is in Perth, WA, which is incidentally my home city in Australia. As Australia's official bullion mint, the Perth Mint offers a wide range of gold products with government-backed guarantees. Investors can purchase online or in person with options for secure storage. Next, you have the ABC Bullion. They are a leading bullion dealer offering gold bars and coins. They offer online purchasing, in-store services, and secure storage solutions. They are available nationwide with locations in Sydney, Melbourne, Perth, and Brisbane. Next, we have Ainsley Bullion with locations in Brisbane and Melbourne. They offer a variety of gold products, including their own branded bars and coins from international mints. They also provide storage options and services tailored for self-managed super fund investors. Then you have Guardian Gold with locations in Sydney and Melbourne. They specialize in gold and silver bullion, offering both sales and secure storage through Guardian vaults. And finally, we have Gold Bullion Australia, which is located on the Sunshine Coast, Queensland. They provide a range of gold products and has recently expanded to meet growing demand. The main advantage of physical gold is that it's a tangible asset. Unlike other digital assets, you can actually hold it. It's physically real. It doesn't rely on a bank, broker, or financial institution, so there's no risk of default or bankruptcy. Unless, of course, humanity collectively decides that gold is no longer valuable. The main disadvantage of physical gold is that since it's physical, there are storage and security risks. Keeping it at home makes it vulnerable to theft, while storing it in a private vault can be expensive and inconvenient. And adding insurance on top of that creates another layer of cost and complexity. The second and more modern way to invest in gold is through the stock market. In Australia, you can buy shares in gold mining companies to gain exposure to gold. However, this is a high-risk, high-reward strategy. A safer alternative is to invest in a gold ETF that tracks the price of physical gold and is backed by actual gold. This reduces your exposure to individual company risks that come with investing in specific gold stocks. The Australian Securities Exchange, or ASX for short, offers a variety of gold-backed ETFs that provide investors with exposure to the price movements of gold without the need to physically own them. A gold ETF works just like any other ETF or stock on the ASX. The main benefit is the convenience of being able to buy it within minutes on your smartphone. So here's the table I've made for you showing the 5 most popular gold ETFs in Australia, ranked by assets under management. Now please note, these are not buy recommendations. I'm just showing you some popular examples so you can do your own research. All 5 ETFs track the price of gold in Australia, and they are all backed by physical gold stored in secure vaults. While these ETFs all track the price of physical gold, each of them have their own unique features. Let me quickly walk you through each one. First up, we have the Global X Physical Gold ETF, ticker symbol GOLD, which is pretty easy to remember. It's the biggest gold ETF in Australia with around 4.7 billion in assets under management. It's backed by physical gold stored in London and has high daily trading volumes over 50 million. The management fee is 0.4% per year and it's unhedged, meaning its returns are influenced by movements in the Australian dollar against the US dollar. Over the past year, it's been a strong performer with over 43% in annualized returns. Then there's PM Gold, the Perth Mint Gold ETF. It's got around 1.4 billion assets under management, charges a super low 0.15% management fee, and stores its gold right here in the Perth Mint. Shout out to anyone who's from Perth. What makes PM Gold unique is that it's backed by a government guarantee from Western Australia, adding a layer of security for investors. It recently reclassified as a structured product, but it still offers the ability to redeem units for physical gold. If you're concerned about currency fluctuations, the Beta Shares QAU ETF might interest you. It's the only one in this list that's fully hedged the Australian dollar. It charges a higher 0.59% fee, but for some, the currency protection may be worth it. Like Global X Gold ETF, it stores its physical gold in London vaults, managed by JP Morgan. For newer options, iShares GLDN and VanEck NUGG have been gaining some traction recently. GLDN has a competitive 0.18% fee and has delivered around 18% on average per year since its launch in October 2023. It also stores its gold in London vaults. Meanwhile, NUGG sources its gold bullion from several Australian producers and allows physical redemption. It's smaller in size with around 126 million assets under management, but has returned over 27% on average per year since launching in late 2022. In Australia, you can buy gold stocks or ETFs through any investing platform that allows trading on the ASX. Here are the 5 steps to buy gold ETF in Australia. Step 1. Open a brokerage account or an investing platform. You'll probably want one that has low brokerage fees and is CHESS sponsored. The brokerage fee is how much you pay the broker every time you buy or sell shares. So ideally, you want that to be as low as possible. A CHESS sponsored broker offers direct ownership and registration of your shares through the ASX system. This means you legally own the shares and you'll receive a holder identification number. This makes your shares more secure and allows you more control. Not all brokerage accounts offer this. Some use a custodian model, which means your shares are technically not under your own name, so please choose carefully. I'm currently using the Moomoo app to invest in the ASX since they are CHESS sponsored and have one of the lowest fees in the market at around $3 per trade. Step 2. Search the ASX code or ticker symbol. So go ahead and open up your brokerage account. In this case, I'll use Moomoo as an example, so let's open up the app. You want to click on this magnifying glass symbol at the top. Now you can search for the ETF you want to invest in. For example, let's search for the appropriately named Gold ETF by Global X. So type in GOLD, make sure it's the one in Australia, and there it is. Let's click it and it'll bring you to this page. I would encourage you to take some time to explore this page and get familiar with all the investing terms, metrics, and data. Moomoo also has this helpful feature that lets you search for themed ETFs, also known as thematic ETFs. This is where you can find gold ETFs and other themed ETFs. Step 3. Decide how much you want to invest. Once you're ready to buy, click this trade button down here and select this green buy button. Here you can decide how many shares you want to invest in. So let's say you want to buy 20 shares of gold ETF. You can change the quantity here to 20, and you can see the buy amount will update. Step 4. Place a buy order. Now you can buy in two ways, through a limit order or a market order. A limit order allows you to set the price you want to buy at. For example, one share is currently worth around $47. Let's say you're only willing to buy at $40 per share. You can go ahead and change the price to $40. The time in force is the amount of time you want this order to be valid for. If you leave it as day, the order will automatically cancel if the share price does not fall to $40 on the same day. You can also change it to good till cancelled, which will make the order valid for the next 90 days, or you can pick a specific date by selecting good till date. So with the limit order method, you would have to wait until the share price goes down to the buy price you've set. If you don't have time to wait around and you want the order to go through immediately, then it's better to use the market order. So let's select market order type instead. We'll keep the quantity at 20, and here's the new estimated amount. Please make sure you have transferred enough money into your account. Step 5. Review and confirm your order. When you're ready, click the buy button. A final order detail page will appear. Please carefully review everything one last time. Once you're happy, click confirm and your buy order should go through instantly. Congratulations, you just bought your first gold ETF. And if you're interested in using Moomoo to buy other shares or ETFs, they currently have some juicy sign-up bonuses for my audience. If you sign up using the link in the description, you'll receive up to 12 free random stocks when you make a qualified deposit and keep a minimum account balance for 30 days. You'll also get 0 brokerage fees for 30 days. So that's free brokerage fees for a month for you to try out this app for free. And if you don't like the app, no worries, you can simply withdraw your money and keep the free stocks. That's a pretty sweet deal. Please note terms and conditions do apply, so make sure you read them before proceeding. I'm not sure how long this offer will last, so if you're interested, use the link below to sign up and claim all the free rewards on screen. And if you're watching this in the future, I'll provide a link to the current best offer. The sign up process itself only takes a few minutes. Enjoy. So if you're a first time gold investor, here are a few tips to consider. 1. Research dealers. Please ensure you buy from reputable dealers with a strong track record. Don't just blindly believe everything you see on the internet, including this video. Make sure you do your own due diligence, because at the end of the day, no one cares more about your money than you. 2. Understand the product. Be clear on the type of gold product you're buying and its resale potential. 3. Consider liquidity. Smaller denominations may offer greater flexibility when selling. If you're investing in an ETF, one with a higher assets under management may provide better liquidity. And 4. Stay informed. Keep up to date with market trends and economic indicators that may impact gold prices. So who is gold suitable for? Now, I'm not recommending whether you should or should not invest in gold in this video, but I will point out who it's generally more suited for. Gold is more suitable if you're the following. 1. A risk-aware investor seeking a hedge. Gold often performs well during economic uncertainty, inflation, or geopolitical tension, all of which are present at the time of filming this video. You benefit if you want to protect part of your portfolio from stock market volatility or currency risk. 2. A diversified long-term investor. Gold typically has a lower correlation with equities and bonds, helping reduce overall portfolio risk. You benefit if you're aiming for asset diversification in a balanced portfolio. For example, a 5 to 10% allocation to gold. 3. You're worried about inflation or currency devaluation. Gold has historically held value when fiat currencies have weakened. You benefit if you're concerned about continued inflation, real interest rate drops, or the AUD to USD volatility. 4. You're a passive investor looking for simplicity. Gold ETFs offer exposure to physical gold without needing to store or insure it. You benefit if you want set and forget access to gold with low management fees and easy liquidity on the ASX. And 5. You're an Australian investor preferring local access. With ETFs like PM Gold backed by the Perth Mint and traded in AUD, you avoid complexities of overseas gold markets. You benefit if you want to invest in gold without worrying about forex conversion, offshore accounts, or physical storage. Alright, so now that we know who gold is suitable for, how about who it's not suitable for? You may want to avoid gold if you are 1. An income-focused investor. Gold does not produce dividends or interest, which means it generates no regular income for investors. If you're focused on cash flow, like retirees, income-focused investors, or those building passive income, gold may not meet your needs. Unlike dividend-paying shares, bonds, or real estate, gold relies solely on price appreciation for returns, which can take time and comes with greater uncertainty. 2. You're a speculative or short-term trader. Gold prices can swing sharply in the short term, driven by unpredictable forces like interest rates, inflation, and global events. This makes it hard to time, and short-term traders often risk buying high and selling low. Gold is better suited as a long-term store of value, not for chasing quick profits. And 3, you're heavily concentrated in commodities already. If you're already heavily invested in commodities, adding gold may actually increase your portfolio's risk rather than diversify it. Gold is still a commodity and often reacts to similar macro forces like inflation, global demand, and USD strength, so it won't protect you in a broad commodity downturn. It also adds to volatility and concentration, especially for Australian investors who already have indirect exposure through local resource stocks. In summary, gold could be a valuable investment for those concerned about inflation, global conflicts, or risk to traditional currencies. You could consider allocating a portion of your portfolio to gold as a hedge against inflation and market volatility. However, please remember that gold usually works best as a complement to, not the core of, a broader investment strategy. And quick disclaimer, this video is for educational purposes only and should not be considered financial advice. The assets and ETFs I mentioned in this video are not buy recommendations and are used as examples only. Always do your own research. Investing involves risk, and past performances is not indicative of future results. If you'd like financial advice, please go speak to a professional. By the way, if you're enjoying this video and made it this far, comment the word nugget down below so I know who you are. And if you're new around here, what are you waiting for, mate? Hit that subscribe button and join this wonderful community of like-minded people. Also, please consider signing up for my free newsletter, Aussie Money Club, where once a week I'll send you some money tips, major news in the market, or any cool live updates from me. And if you want to learn more about gold ETFs, check out this video on screen where I'll discuss some of Australia's most popular gold ETFs in greater detail. And as always, thank you for watching, I appreciate you, and I'll see you in the next video.